The market is closed for the weekend, having concluded the last session with SoFi Technologies Inc., SoFi, stock closing at $26.54 on Friday, October 17, 2025, representing a slight intraday loss of 0.23% or 6 cents from its previous close. This specific price point, however, is a deceptive calm before an anticipated storm of earnings reports, and the real story isn't the marginal movement, but the massive undercurrent of institutional rotation. While the retail consensus sees SoFi simply as a high-growth, meme stock darling still enjoying the post-student loan moratorium exuberance, the deeper reality is that institutional money is beginning to price in a distinct, two-part structural shift: the successful de-risking of the loan book via the bank charter, which is a major, underappreciated win for stability, and the accelerating higher margin contribution from its Galileo and Technisys technology platforms. This narrative of a company transitioning from a pure-play consumer lender to a diversified fintech infrastructure provider is the true engine driving the long-term bullish expectation, and the stock's recent consolidation near its 52-week highs, though punctuated by profit-taking like we saw Friday, speaks more to accumulation pressure than exhaustion of the rally. The common expectation has been that SoFi's fate would remain inextricably linked to the interest rate environment and the performance of its consumer loan portfolio, making it a high beta bet on the macroeconomic cycle. Reality, however, is now forcing a critical reevaluation of this assumption. The stock has surged over 160% in the last 6 months alone, a move that massively outpaces the broader financial sector, and this cannot simply be attributed to the tailwinds of the student loan market restarting. If it were, we would be seeing a much less stable price action. Instead, the stability we see in the mid to high $20 range, despite a few shaky days that have become the new buying opportunity, suggests that the market is beginning to value the financial services and technology platform segments far more aggressively. The intelligent portfolio offerings and the underlying technology platform Galileo, which powers numerous other fintechs, are turning the company into a capital-light engine, moving away from the cyclical, capital-intensive lending model. We are seeing major institutional holders increasing positions, with a significant number of new positions opened in the last reporting quarter, even as some high-frequency traders take profits following the explosive rally. This is a classic sign of long-term money validating the structural shift, moving past the hype cycle and into the fundamental growth story. For example, a look at recent 13F filings shows hundreds of millions in new institutional capital flowing in, indicating a conviction that the profitability trajectory, driven by cross-selling and cost efficiency enabled by the bank charter, is set to significantly accelerate, defying the skeptical consensus that the current valuation is stretched. This sets up a profound tension heading into the late October earnings report, where the company needs to prove not just loan growth, but a decisive expansion in its non-lending revenue streams to justify this valuation. Recent daily stock movement has been characterized by high-volume swings, particularly around key analyst revisions. When a major firm, despite raising their price target, maintains a hold or even underperform rating, a bizarre dichotomy we've observed recently, the stock often sees immediate, though temporary, selling pressure. This highlights the psychological friction between the reality of operational outperformance and the lingering skepticism on Wall Street, which is still using traditional bank valuation metrics like price to book, metrics utterly inadequate for a growth-focused fintech like SoFi. The recent announcement of expanded options trading for SoFi Invest members is another microcatalyst that, while small in isolation, signals an aggressive push into higher-margin, sticky financial services, directly challenging established brokerage and online investment platforms like Interactive Brokers or even the retail-focused Robinhood. This expansion of its own individual brokerage tools strengthens the internal ecosystem, which is the core of the SoFi thesis, turning a single-product customer into a high lifetime value multi-product member. Every new product adoption, whether it's a personal loan, a checking account, or a foray into online investing via the SoFi Invest platform, increases the overall stickiness and dramatically lowers the customer acquisition cost for the next product. This strategy stands in contrast to the single-threaded businesses of older financial giants like Fidelity with its legacy mutual funds and brokerage accounts, or the simpler trading-focused model of Robinhood. SoFi is building a digital ecosystem, which gives them a superior operating leverage. Their incremental customer cost is falling, while their revenue per customer is rising, a trend that is an absolute rocket fuel for profitability. Older reports confirm the rapid acceleration of product adoption per member, validating this cross-sell hypothesis. The near-term focus remains the upcoming earnings, but the broader sector momentum is also pivotal. The fintech space, while recovering, remains highly competitive. The expansion of Fidelity Investments into more streamlined digital offerings, the continued dominance of interactive brokers in high-frequency, sophisticated trading, and the aggressive move by smaller players all serve as competitive pressures. However, SoFi's unique advantage is its bank charter, which provides a significantly lower cost of capital compared to non-bank fintechs, immediately giving them a structural margin advantage over even rivals with strong brands like Schwab Intelligent Portfolios or any investment site operating without a full charter. This is the definitive edge that turns the possibility of profitability into an inevitability, provided they execute. Looking ahead, the future outlook for SoFi is defined by two key scenarios. The bullish expectation is built on the current reality of accelerating monetization and platform growth. Catalysts for this include a stronger-than-expected Galileo technology platform deal, a significant beat on its Q3 membership growth, and positive commentary regarding the full utilization of its bank charter to fund its loan book. If the company hits $3 in products per member and significantly expands its profit margin from the technology segment, the stock could easily re-rate, challenging the all-time highs and pushing toward new price targets. The risk, however, which must be clearly acknowledged to provide authoritative analysis, centers on credit quality and macro pressures. Despite targeting affluent customers, a prolonged, severe economic downturn could stress the consumer loan book, leading to higher provisions for credit losses. Furthermore, competition remains fierce. If Fidelity or Schwab become too aggressive in the digital space, or if the technology platform's growth slows down, the market will punish the stock. The bear case is that the current rally has fully priced in the bank charter benefit and future growth will normalize back to industry averages, which would make the current multiple of revenue unjustifiably high. The expectation versus reality frame dictates that investors must gauge whether the company can sustain its explosive member and product growth while maintaining credit quality in a high interest rate environment. The reality is that the management's focus on the technology platform diversification is the safety net that makes this stock a calculated bet on a unique future, not just a cyclical bet on interest rates. Ultimately, the long-term narrative for SoFi is a clash between its legacy as a lender and its future as an integrated technology and financial services conglomerate. The market expects a great quarter. The reality is that a transformative quarter, one that clearly shows the technology platform becoming a dominant contributor to margin and profitability, is what is needed to propel this stock into the next echelon of fintech valuations, closer to the big diversified financial giants. The summary insight is this. The recent stock volatility is merely the sound of money rotating from day traders to institutional conviction holders who understand the bank charter isn't a cost center but a profit multiplier. The expectation was that high rates would cripple SoFi. The reality is the bank charter and the Galileo platform are allowing them to execute an end run around traditional macro headwinds. The stock will continue to move less on loan volume and more on the acceleration of its fee-based revenues and cross-selling success within its digital ecosystem. This is a crucial distinction for anyone holding or considering this name. Comment below how many products per member you think SoFi needs to reach before it achieves a stable $50 stock price. The answer to that question will define the next 2 years of its valuation journey, reinforcing the necessity of looking beyond the headline number and into the core of the business model's unique and aggressive pivot to full-stack financial dominance.